My name is Michael Latrue with Parvis Investments, and welcome to another Brick by Brick, where today we'll be covering a fine real estate investment opportunity for all of our fellow investors through Kin Capital. What they are is a very, very distinct real estate play. And with us today, we have our good friend and a very bright gentleman, Mr. David Hannock from Kin Capital.
Hi, everyone.
Just before we get started, a little disclaimer. So this content is not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. Nothing in any presentation shall be construed as a recommendation or offer to sell or solicitation of an offer to buy any securities. That being said, this is poised to be very informational. And then if it's something that you are interested in learning more about, we do encourage you to reach out to myself or your fellow dealing representative at Parvis to learn more about it and how you can get involved. So for those of you who are new to Parvis, or this is your first brick by brick joining us here today, Parvis Investments, we are a full service exempt market dealer. And what that means is we give you access to distinct private equity opportunities out there in the marketplace. We help investors get fully involved in private market opportunities to help enhance their portfolios, as well as take more defensive positions when markets go a little bit awry. And we do perform independent due diligence to confirm the accuracy of all of the issuers that we present on the platform to ensure completeness, as well as all of the information we do share for investors. And the reason that we do exist is to democratize access to private markets for Canadian investors who want to continue building wealth and want to diversify outside of the standard, basically the standard public market space. So if you're tired of getting calls from the bank for your GICs or bonds and want to fully invest directly into real estate as an example, Parvis is one place you can definitely do that. And we will take very, very good care of you doing that. We have successfully raised lots of money for several successful funds across Canada. And we continue to have great investment opportunities show up on our platform on a very regular basis. Hence why we have Kin Capital with us today. As I mentioned earlier, my name is Michael Latrue. I'm a dealing representative with Parvis Investments. Feel free to scan the QR code below if you'd like to get in touch later after this session. I am happy to get in touch and then answer any questions you might have. All right. So without further ado, I will pass this off to Mr. David Hannock from the Kin Income Fund. Many years in the industry, and yeah. So we'll have a little bit of a conversation while Mr. Hannock presents to us the overall thesis of the offering, and then we'll go from there. So please, David, welcome and thank you for joining us. And in a few words, just tell us a little bit more about the Kin Income Fund.
Thanks, Michael. Just for everybody out there to hear about myself a little bit, I have 15 years of focus on Canadian multifamily, particularly in the value add space, which you're going to see today. I was formerly a senior executive at Starlight Investments, who you may have heard of as Canada's largest owner-operator of multifamily with over 70,000 units. So extensive experience in this opportunity. My partner and I, Jacob Ifta, saw a dislocation in the marketplace, particularly in Montreal. Montreal, if you may know, is a quite large city. I think it's undervalued and underlooked. It has 4.5 million people, is extremely affordable by Canadian standards. So our overall thesis, just at the highest level, is finding a dislocation in the marketplace between value and price, acquiring properties where we see that value, creating additional value, and then reselling the properties into the marketplace as we see values rising. So to use the shopping analogy, it's like going to the grocery store or any department store and seeing things at 30% discount. You buy them then and you're happy. You don't run in when it's full price. What we see here is a disconnect, and we see a great opportunity to acquire properties while the market is at or near the bottom. If you want to just flip the page,
Your
One more
most
time.
expensive slides of any deck.
Yeah,
But
couldn't agree more. One more time.
there we
So
go.
really, so really, I'll give you the executive summary and we can work our way through it. We've created a new income fund. It's plan eligible, RSP, RESP, TFSA, whatever your plan is. Our strategy again is a value add strategy. So we're not developers and we're not buying new product. What we're doing is going to the submarkets of Montreal where rents are very affordable, where you'll see no cranes in the sky, supply is low, demand is high, and we are taking older product, classic Canadian apartments, 1950s, 60s, and 70s. You've all seen them, you probably have lived in them at some point, and we're renovating them to a modern standard. We're preying off the supply and demand market fundamentals, as many of you have heard throughout the last 5 to 10 years. Canada had a large immigration, people migrating into Canada. A lot of the working class were there, even though it was a point system. Housing is scarce. Most people cannot afford to buy a home, and that's only getting worse. So we're taking advantage of that opportunity. At the same time, CMHC and general borrowing has come down. So off of what I would say in my lifetime, all-time highs. So we're seeing CMHC, which is government insured funding for apartment buildings or housing from Canada Mortgage Housing Corporation, at or near lows in the last 5 years, somewhere between 3.3 and 3.5%. So, on a technical basis, for anybody out there who's a technical real estate investor, our stabilized cap rates are 6.5, and our borrowing rate is 3.5, creating a nice, healthy spread, which we are taking advantage of and creating investment income and opportunity. If you want to
Excellent.
just flip the page. Again, you can see our going in cap rates are probably 4.8 to 5. We stabilized to 6.5. We have a cornerstone investor, a Montreal cornerstone investor who is not a real estate investor, but really liked the opportunity, and they have committed $30 million to the structure. As I mentioned, it's an income fund, but it's plan eligible, and our returns are in the range of value add. 16 to 18 IRR. So what that means is your annual return, your total annual return over the number of years would be 16 to 18. So if it was 16 and it was 3 years, it would be a 48% return. You'll see that we have an equity multiple of 1.8 to 2.2, which means if it's 2, you've doubled your money during your investment. And once buildings are stabilized after about a year or a year and a half, we target a 6 to 8% cash on cash return. So income should be able to be distributed, not in the beginning, but as we move through the piece. I'll
Excellent.
just flip
Well,
to
that's
the
what you want. You want
next.
to make sure things are stabilized before giving
Exactly.
people money.
So the strategy again, we're trying to create credit-like cash yields with upside potential. We're buying assets that are older vintage and we're renovating them. We have built a team around us of top-tier advisors. We have a best-in-class Montreal operator, so a local operator who lives, breathes, sleeps the market. We do not buy in downtown Montreal, just to be very clear. We're buying in the submarkets, what you would call the suburbs. And we like that because there has been no new development in a significant amount of time and there's none planned. So what you see is what you get, and the opportunity is to take those buildings and make them nicer, more inhabitable, and increase the rents. Next slide.
Excellent.
As you can see, vacancy rates in Canada have been historically strong. So occupancy is historically strong. Montreal has been stronger than the other markets. And that really speaks to the affordability of the city itself. And when you talk about rent growth, you can see, of course, Alberta, you see Edmonton and Calgary go up very high, but they come down very quickly as well. Montreal is stable, and because rents are, as I said, affordable, when you get small increases in rent, the aggregate rental price is still affordable to the average everyday Canadian. And that makes the market accessible to all and gives space to increase rents on newly renovated units.
Do you suppose the this affordability will continue on, even though there seems to be a lot of new people coming into Montreal? I mean, as occupancy rates continue to decrease, I guess, would that
Well,
present an opportunity for the fund as well, you believe?
yes, I mean, occupancy, our stabilized occupancy on our buildings after renovation is around 99%. You'll always have a
Wow.
few units offline to renovate, and those units, as they come online, we create new rents which match the market for something of that quality. Yes, we see two sources of demand. We see just the number of people in the marketplace, and then we see our product as an improvement to the options around it. So if you live in a neighborhood or are moving to a neighborhood and you see two choices, what you'll find is our service standard is far higher than the average owner of a multifamily property. We take great pride in taking care of our tenants. We make the common areas clean, bright, safe. We put in intercom, lighting, paint to make it safer, improve door locking systems on the outside. And then, of course, on the inside, we turn each unit as it becomes available and only when it becomes available.
Excellent.
Do you want to just flip?
All right. Perfect.
So CMHC, as I mentioned before, is how we finance our properties. That is really a government insured mortgage. They give you, there's a point system in what's called MLI Select. And what that really means is if you undertake to do energy efficiency and some affordability in your building, the government of Canada will insure a mortgage, which could have 40 to 50 year amortization at a much lower rate because the lender is not exposed. The government has insured the loan itself. What that's really doing is creating a nice, healthy spread between the cap rate or the yield and what you're paying to carry the building itself. And in that space, that's where we really make our profit and we return it to you, the investor. Next slide. Just so you understand Canada versus the United States, many of you may have invested in multifamily in the United States. I too operated for 12 years in the United States. Supply demand fundamentals in Canada are much tighter. Canadians are less migratory. So when markets are tight, they stay tight, whereas Americans just move where the jobs are. The debt market in Canada has government insured, which makes it far more attractive. Canada has less equity as a general rule to buy these buildings. So institutions are not as prevalent in this market as they are in the United States. And there's much wider spreads with much less volatility because of that. So what we find is stabilized interest rates, and we only use fixed at KIN. Cap rates which compress slowly and are not like a roller coaster, which creates predictability in the returns profile.
And with the fixed rates, are you typically in a 5 year, or do you take longer terms on fixed
We
rates?
do 5 and we do 10. It depends on what's available. And we try and take our portfolio and stagger it so that what you don't have is all your properties coming due at any one time. And that's a mitigation strategy so that the portfolio itself doesn't go through the ebbs and flows entirely all at once. And you can sort of average over time what your interest rate is. That's very helpful. The Canadian marketplace, private owners own 80% of all apartment buildings in Canada, believe it or not. Institutions historically have not. They did not want to be seen as evicting their own pensioners who weren't paying rent. There's a bit of a conundrum for them there. There's mostly private buyers, and then there's some public REITs. The opportunity for the private buyer is that the private buyer in our strategy takes some of the capital to renovate the buildings. Public REITs pay distributions, and what they do is defer their CapEx, and they can't really afford to carry older buildings and bring them to today's standards. Public institutions like yield, and they too don't spend their money to renovate the units. This is a total return play where we use some of the capital to renovate the units, bring the rents higher, and then create more profit at the end on each building. These are just some of our this is some of our advantage. These are the types of advisors you see working with us. So best of the best in Canada, whether it's legal, brokerage, advisory, tax, investors. This is what you get. This is who we work with. We don't cut corners on any of this. This is very important to us to make sure everything is done well. This is just how our structure itself works. So investors will be investing in Kin Income Fund at the very top, the triangle. That's the plan eligible structure. And then below it, you have a number of limited partnerships. Those create opportunities to actually buy property on tax deferred basis for sellers, which creates more meaningful opportunities for you, the investor, without actually uh, requiring more capital. And then we have what I would call a very standard setup at the bottom, where we have a property level limited partnership as well.
Excellent. And then a question I typically get from investors as well, all these things are nice and good, but how much does the actual fund managers or the participants or the people that are bringing the fund to light, how much skin do they have in the game
Sure,
typically?
that's a very good
And
question. So my partner and I own 10% of the fund. We have put in millions of dollars into this ourselves. It's a meaningful checks from us. We are just like you, we're investors. First and foremost, we're investors. And what we're actually asking you to do is come along and be our co-investors. So you'll see all of the materials we send to you will address you as dear fellow investors, because that's what we are. You will receive audited financial statements on an annual basis, and we're finishing our audit right now for 2025. You will receive quarterly reports, which will be in a sort of glossy format where you'll get the highlights of what's happening in the portfolio. You'll understand the renovation program. You'll see the before and after. You'll understand the trend in the portfolio itself and where we're at. So you'll understand how much suite turns are generally costing. You'll understand where we are compared to budget, but it will be done in a very user-friendly, accessible way. But to answer your question, Michael, we too are investors, and that actually incentivizes us to make rational economic decisions because we're equally aligned as you. We want to sell the properties at the exact right time to sell the properties. Although you can't time it perfectly, you can see the trend. And that's when we want to exit and return all your money to you as well. Because in the end, we're all in it in exactly the same boat, going exactly the same way.
Excellent. I like it.
Just a little bit of our timeline so you understand it. We started the fund or the trust in early January last year. In July, we bought our first property in Montreal, in Rosemont. In September, we achieved our cornerstone investor. In September to December, we actually expanded our portfolio to 200 million. We are continuing to raise equity, and we're seeing some significant opportunities from institutions to partner with you investors and continue on this journey and buying more property. We do expect to exit in 3 to 5 years. That should be anywhere from 2028 to 2030. Of course, what we try and do is make the market work. So what we don't want to do is promise you an exit date, because we don't think that is reasonable. And we've seen lots of our peer group who promised a date just change the date. So what we're going to tell you is, as a co-investor, we're going to do it at exactly the right time. We hope it's sooner than later, of course, but we're not going to lose the ability to earn more for you and for us if it's not there at that exact moment. You can see this is just a bit about our track record. We've done quite a bit of development. As I mentioned, I was a participant in another organization that went from 0 to 30 billion of AUM. We're trying to deliver risk-adjusted returns. And what we see in this, what we call value add, which is the renovation sort of older stock, is you have income being produced at the property at all times, but at the same time, we see an opportunity to increase rents by renovating it on a risk-adjusted basis. We think that is the best return we could find at this moment in time in Canadian real estate, and particularly in the Montreal geography, where we see the market at or near the bottom. This is just about our operating partner, Very Group in Montreal. They own and operate one of the largest high-end apartments, but we brought that exact standard of how we manage buildings to the value add. So what happens in most of the older buildings is there is limited to no service whatsoever. We actually deliver service. We take care of our tenants. It's very important to us to do that. I can tell you a quick anecdote that when we bought our first building and we were going around to meet all of our new tenants door by door, one of the tenants said, "Who are you?" And then said, "You're not going to last very long. Nobody does here. and slammed the door on our property manager's face. 6 months later, he shakes his hand every time he comes in the door. That's the kind of people we are. We take care of our people, and we really like we want our tenants to feel safe and secure, and we want to show them that there is a better way to live in this sort of need to rent space.
Excellent. So you're uplifting all the living standards for all these older buildings that you're acquiring.
Definitely trying. We are definitely trying.
Excellent.
Here you go. This is our cornerstone investor, Thornhill Capital. You can see they've done quite a few investments in the past, but not in real estate. This is their first foray into real estate, believing in the compelling opportunity.
Excellent.
This is our team. It's my partner, Jacob Ifta, and myself. We are, between us, we have 40 years in this business. We understand it quite well. We see the dislocation today, and then we have an advisory board who we talk to. They're independent, and they really help us to generate new ideas and to talk through issues as they come up, like every business does, in a stewardship way. That's just a little bit more about us.
Yeah, more reading to do. All right.
Yep. For sure.
Here's one of the case studies. Well, this was your first. Was this the first one?
This was. So this is outside of the REIT. What we did basically is we tried a test case to make sure the thesis worked before we brought it to you. We didn't want you to see something that we hadn't tried, tested, and true. So what this was is we had an opportunity in Dorval to buy a property. It was a value add property built in the 60s, and functionally what's happened is the business plan is well ahead of schedule. The value on the property is the year 5 value, a year and a half into it. We've turned a significant number of suites, and when we say turn a suite, it means plank flooring, halogen lighting, a new kitchen if necessary, and a new bathroom if necessary. Some units are in better shape than others, obviously. We budget around $22,500 per unit, and generally speaking, we've been coming in well below that at $7,000. This building is under contract to be sold and should be firm this week. Very exciting to get the 5-year value in less than 2 years. So that's just an example of one that we tested outside of the REIT itself.
And then who would be the potential buyers eventually?
The buyer of this one is a private group. They didn't have the wherewithal to do the value add themselves on the first set of units and to stabilize the building, but they're interested in continuing on the program after we leave. So we leave some for them to do as well and to create some value for them as well. But they didn't have the vision to do it on the outset. Now, this is kind of what you get when you see a renovation from us. So you can see an older bathroom to a newer bathroom, an older kitchen to a newer kitchen. Most of these buildings don't have laundry in suite, which is very common for the older buildings. So you'll see a brand new laundry room with new machines. We actually have technology so people can book the machines with apps, so they don't have to go down and see if the machine is available, which is a huge benefit. Actually, everybody on the call, the most annoying thing to tenants when you ask them what did you dislike the most or like the most about a building, they'll generally say the laundry room, which is a very interesting fact. And then you'll see we update the lobbies to make them more modern, more welcoming, more inviting, because when you come into your home and when your guests come, they should feel welcome, invited, and safe.
I did not know that about the laundry rooms. That's an interesting fact.
Very true fact. You can see we have a whole bunch of other buildings under contract or acquired. We've just acquired one at Rue Mistral. We have First Avenue. We have Domaine Choisy. All of them different sellers, but very similar characteristics. Older buildings, opportunity to renovate, opportunity to increase rent, opportunity to make people's living experiences better. That's generally what it is. And I've discussed the general thesis of the cap rate as the stabilized cap rate as compared to the financing rate. This is just First Avenue. The building is, as you can see, the building is now stabilized. When we got the building, there was actually 25% vacancy. Now there's 2% vacancy. We've renovated 30% of the units, which is well ahead of business plan. The appraisal has come in at significantly higher than acquired price. the proof will be in the sale itself, but the trend is in the right place. This is a 50 unit building, so we went smaller to start to make sure that it was working well. It works well, and we continued on. So,
What would you attribute the initial vacancy rate to? Would it just be
often we ask the
same
landlords
operator?
velocity, a few things. One, the operators don't generally operate well. Two, we ask them, once we go firm on a deal, we actually ask them to stop leasing the units because we want to renovate the units right away to get that quick value lift. The key to a value add program is actually vacancy or velocity, people leaving so you can keep doing it. We don't ask them to leave ever. We don't pay them to leave. We don't do any of that type of stuff. But this market has a healthy natural turn to it, which helps the program itself.
Excellent.
And this is just what you see when we got it. The building needed a lot of love. There was garbage everywhere. The kitchens in some of the units were not beautiful. Now you get, your standard subway tile, your nicer bathroom, your bigger vanity, etc. So this is really a repositioning program to bring you to what I would call a modern, livable standard, not what you remember as your first apartment building.
The university days.
Domaine Choisy, exactly the same, just a much larger site. It actually has a number of buildings on it. The program is exactly the same. This is all about creating value by attracting tenants, some of them who had left who are now coming back because they see that professional management is taking care of their buildings, and they're very excited. A lot of referrals happening here. It's a big community, and we're engaging with people to make them welcome, and we're moving building by building through the process. Another interesting thing about this building, you'll see in the bottom right, that piece of grass. That piece of grass is actually as of right, we can build 40 units as a new building on that piece of grass, and actually requires no equity to do it because we carved it away from the mortgage itself. So that's another way to enhance value, another way to create return for our investors and, of course, for ourselves.
Oh, excellent. And would the Vered Group be the ones that could potentially do the build? Are they
Yeah,
equipped
they
for
know
that?
how to do it. Absolutely, they would manage the build, but they would also they're also managing the property with us.
Oh, excellent.
Yeah, it's fabulous. And now Ruben Style, which actually is now not firm contract, it's closed. This was owned by a public REIT. The public REIT didn't take advantage of rents. They were very focused on occupancy, so they never drove the rents. We're finding rents on at least 30% of the units are half of the market rent. So
Wow.
as the units become available, they did a good job of renovating and cleaning, but they didn't do a good job of maximizing rent. So here we're just increasing rent, keeping the building standard, and on the older units, of course, renovating them.
Great pipeline.
This Archevêque building is the last one you'll see here today. It was actually has only had one owner, believe it or not, from the 1960s. And we were selected because we understood the building. We didn't offer the most money. They wanted to give it to a caretaker. It's a piece of family pride. They really liked us as operators. They know we want to take care of the people who live there. This, ironically, has very low rents, significantly below market. There was no mortgage on it from the prior owner, so they were using it to generate cash flow. We see a great opportunity here to get in there, raise rents, and renovate as necessary.
All right. Excellent.
So this is just a key terms and summary, everything we talked about. It's a 3 to 5 year hold. There is no liquidity. I think it's very important to match investors to the opportunity. We don't want people who do not understand the investment because, as we said, we're co-investors with you. We're in it with you all the way till the end. We're taking advantage of CMHC financing. We're taking advantage of a mismatch in the market between pricing and value, and we're on the way to raising our first target goal of $100 million, which should buy us a significant amount of real estate.
Excellent.
The end will be a either sale of the entire REIT at the top or the sale of some properties as a portfolio or individually. And I think throughout the sort of investment period, buildings will be sold and some may be acquired. But You'll start to see some velocity as the business plans get finished, either through refinance, sale. You'll see some motion and some changes in the capital stack and the portfolio as we go. And that's really an exciting time because it means you're completing the business plans and finding out the best and most accretive way for our co-investors to achieve returns.
Okay, so the goal, the ultimate goal of the fund is to sell all of the assets
You got
near,
it.
well, during
You
or
got
near
it.
the end, and then would you start a new fund or
Yeah, we
not sure
would.
yet?
We would. Of course, yes, we would. So the idea here is to return everybody's money in that 3 to 5 year horizon with the profit, and then to to start something different. And hopefully, our investor group will want to come along with us again because of the outcome. There's no guarantees in life, but that's what we're aiming for, and that's what we're hoping for to create some brand loyalty. This is our flagship fund, and we're hoping from there we'll have more opportunities.
Awesome. Well, when you do things right, people tend to keep coming back, right?
Just to show you alignment, everybody, we're not even charging asset management fees in the first 2 years, and we're only working it off of purchase price. So we're not interested in paying ourselves, we're interested in paying you. We are completely aligned with how it works. We are completely aligned to deliver the best product and the most profit to you. And that's really where we want to be. We don't work off of NAV, so we don't create inflated values for inflated fees. That's not like our peer group who does that. We do not do that. Again, we're total return investors and we're co-investors with you.
Excellent.
Our contact information, we're completely accessible. You can email us and we actually respond. You can follow us on LinkedIn. You'll see lots going on. You'll see us at conferences, speakers, panels. You'll see our acquisitions as they happen. You'll see all of the comings and goings of Kin Income Fund and Kin Asset Management. And of course, reach out to us. We're just completely accessible to you as investors, and we're here to talk about it. And if you have any questions as an investor, we of course will respond to you. And we look forward to co-investing with you.
Excellent. All right. Well, thank you, David. I mean, you pretty much answered all the questions I had throughout the whole presentation. But I guess some food for thought that you can maybe share with investors is, considering the current market climate and everything else, because one of the questions, people always ask is, where do I put the money in regard to, what's going on? I mean, lots of investors, they've made good profits in the stock market and now are trying to pull those profits out.
Sure.
And would you say, investing in with yourselves in something like this would be a good overall strategy from a defensive positioning to sort of securitize their
Well,
profits?
the beautiful thing about this real estate is it's income producing real estate. So this is not like development where if you're wrong, you lose all your money. This actually produces income. So it's in a way, it's income producing property, but we can generate more income by doing our program. So multifamily, I always thought about it as a singles and doubles business. Everybody needs to live somewhere. If you think about it defensively, and just as an example, if you have a 100 unit building, theoretically, each tenant makes up 1% of the rent. So as one tenant leaves, you lose 1% of the rent, but you have an opportunity to increase that rent should the market be able to bear it, which we think it can. So the reason I call it more conservative or risk adjusted is you're not going to massively outsize return. You will over time, but no one tenant makes up a lot. So you have downside protection while you have upside, and that makes it a risk adjusted investment.
Excellent. All right. And then you mentioned, so the income portion of it starts after stabilization, so likely in year two of the fund
Year
itself.
two, I'd say it will be year
Okay.
two. That makes sense.
All right. Perfect. And then,
Yep.
yeah. And I guess would those returns be return of capital
Yes, return of
or
capital for your
okay,
initial investment, and then you're into,
capital gains?
yeah, exactly. You'll be getting an annual trust return for your investment too. So you'll get all your tax documentation. It's all being handled by BDO, so everything is on board and ready to happen.
Excellent. All right. I think that answers all of my questions for now. But as David was saying, if you have any questions, feel free to reach out. They are very accessible. I can definitely attest to that. You know, we text each other every now and again. Jacob is pretty quick on the return messages with text as well. And he's but thank you again, David, for taking the time to share with us and answer my questions. And
Always a pleasure.
looking forward to having lots of investors have more conversations with you over time, because
Very
yeah, you
good.
have a great pipeline, man. And oh, actually, do have one more question. Are you focused strictly on the Montreal market, or are there other markets you
We are
feel that you see
investigating,
are
yeah. So we are investigating other markets that show similar characteristics. It's really older supply, less development or no development, affordable rents that have room to go. So we're very particular in where we're going. Um, I don't want to give away all the secrets, but it's close to the Quebec border and it's on in Ontario. You can probably sort it from there. It's a major nation's capital city, but we look for the same sort of fundamentals as we go. So you won't see us in Toronto or Vancouver. We don't think the fundamentals are there.
okay? Yeah, it doesn't follow your thesis. Okay, excellent.
Yes.
All right, wonderful. Well, again, thank you, David, for your time. It's always a pleasure. Love having conversations,
Okay.
and thank you for joining us on our on this this session of Brick by Brick.
Very good. Thank you, everyone.
Thank you.